For having me today. I really appreciate it. I'm also a resident of the city of Fairfax, so I use Fairfax County libraries on a regular basis, and it's wonderful to be speaking to some of the patrons today. Uh, April just happens to be Financial Capability Month. It's an important time where many people take stock in their finances. How are they doing? Are they building wealth the way they hope to? We'll talk about that today. I'm going to share my PowerPoint slides here. Hopefully you're seeing these now. And of course, I have to give a disclaimer too, because I work for the federal government, that the words and views that I express today are my own, not necessarily the views of the U.S. Securities and Exchange Commission or our commissioners or my fellow staff. And always important to note, I'm not giving legal advice or even investment advice today, but we are talking about tenets of sound investing and how you can build wealth over time. So thank you for joining us. This is about what we're going to cover today. We'll talk a little bit about credit and debt because you can't really teach investing in a vacuum. You have to back up a step and ask people, hey, do you happen to have high interest debt like credit cards? If so, let's talk about a few things you need to do beforehand. But then once you get your credit card house in order, we will begin talking about building wealth through saving and investing, both important concepts, but a little bit different than one another. We'll talk about technology in investing. We get so many questions about crypto and about investing apps like Robinhood that we'll try to cover that, so you know a little bit about things you should be keeping in mind, considerations, risks, etc. Planning for retirement, always an important concept, because for most of us, that's the primary long-term investment that we have, right? Maybe we have a 401k, maybe we have an individual retirement account. And what we're really hoping for is that there comes this day somewhere way down the line where we don't have to work every single week to cover our expenses, like where we will have actually accumulated enough wealth that we can stop working. That's the goal. We all want a comfortable retirement, right? And then no matter where we are in our investing journey, there's always going to be some bad actors out there. So we want to know how to spot a fraud, a scam, and how to avoid it. So we'll talk a little bit about that at the end. And everything that I will discuss today is covered in some depth on our website for Main Street investors. Our website is investor.gov. So if you don't mind, please write that down, investor.gov. Important website, has a lot of tools and resources that you can use to be a more informed investor. This is how our landing page looks here. And we'll talk about some of these tools as we move along. Okay, again, I said I would talk a little bit about credit, and this is kind of that ideal situation that you can have with a credit card, right? You incur a debt, whatever, you use the card, you put it in the chip reader, you paid for something. A couple weeks later, you get a bill, pay off that whole bill. That means you're not only going to establish a credit score, but if you do that on some regular basis, you'll even improve your credit score. But the problem, of course, is some of us don't show a lot of discipline. We sometimes use our credit cards too much to the point where we actually can't pay it off at the end of the month. We have what's called a revolving balance. It's huge interest, right? Ends up costing a lot. Here's just one example. If you saved up all your money on the left and you bought this very high-end laptop, it'd cost you about $2,000. You paid it off in one day. But if instead you put it on your credit card, if you only made the monthly minimum payment, and a lot of consumers think, hey, that's a big favor the bank is doing for me. I only have to pay this very reasonable fee every month on my credit card bill. But in fact, the bank is hoping you'll only pay that little fee because they can extend your debt over decades and collect fees and interest. So in this example, it would take you 5 years to pay off that laptop, and look what you end up paying for it, something like 50% more at the end of those 5 years. So no, we don't want to abuse our credit card. We want to be very disciplined with it. And if we have that debt that we can't afford to pay off, then we want to get aggressive. We want to pay that down as quickly as we can so we can limit some of those interest charges. Takeaways here, these all come from our friends at the Consumer Financial Protection Bureau, the CFPB. That's one of our sister agencies. They say pay your bills on time. Don't go all the way up to your credit limit, right? If you have a $10,000 credit limit, don't put $9,000 of charges on your card. Why? Because you're going to impair your credit score, at least temporarily. Long credit history helps you. So hold on to cards, even if you don't use them very often, those cards that you already have. But don't open up new cards that you don't need. Okay. So the classic example is you're at TJ Maxx and they say, hey, do you know you could have saved an additional 10% today if you open up a TJ Maxx card? Well, think long and hard whether you need any retailer's credit card, because every time you're opening up a new credit card, you're going to impair your score, at least temporarily. And this is just good, solid advice no matter where you are with your credit. Check your report on a regular basis. There's a website that allows you to do this for free. It's annualcreditreport.com. When you go to annualcreditreport.com, you can pull your credit report from each of the 3 main credit rating bureaus. That's Experian, TransUnion, and Equifax, 1 time per year for free. Okay. Annual credit report, and you can make sure there are no errors, right? Each one of these credit rating bureaus has a mechanism on their website to contest errors that are made. And believe me, there are errors that are made. That someone may think you didn't pay a utility bill or that you were late on a credit card payment. If you can show that you paid it, you have a way to contest those marks on your credit score. So very good advice to check that on a regular basis. Okay. That was my very short synopsis on credit and debt, because what we really want to talk about today is building wealth. And so let's just assume we're all using our credit card in a very disciplined way. I define discipline as only putting as many charges on your credit card as you can afford to pay off in full at the end of the month. Why? Because then you don't pay those interest charges, right? Then it's a neutral transaction. You're just using your credit card to float that debt or for convenience. You're paying it off every month. You're not being charged extra interest. So how do we begin building wealth? Well, first thing, we're going to start with saving. There's any number of reasons we save. We might want a house someday. We may want to go on a trip, get an advanced degree, whatever. But here's one of the very important purposes for saving, and that is those unexpected expenses. It turns out a very key point to building wealth is just establishing a rainy day fund, an emergency fund, a little bit of money that you have salted away so that if you have an unexpected expense, you can cover it without going into debt. There was a survey a few years ago by the Federal Reserve that showed that 40% of us would have to borrow money or put it on a credit card if we had an unexpected expense of only $400. So a relatively reasonable amount of money most of us don't have salted away. The experts say, hey, set a savings goal. Try to get up to the point where you can put several months of your expenses into a bank account so that if you lose a job, if you have a health crisis, you're covered. If you have those one-off opportunities, some of you just got tax refunds. Some of you may get birthday money or holiday money. Put a little bit of that into your rainy day fund. And then for the rest, do some saving automatically. What do I mean by automatically? I mean that if you get a paycheck, some of us get it 26 times a year, right? Every 2 weeks. If you have a paycheck that comes from your employer and gets direct deposited into your bank, have a little bit of that put aside into a savings account every single pay period. Why? Because you will adjust your spending, right, to whatever's left over. That's your discretionary spending amount. But that piece that you've sent automatically to an emergency fund will go every pay period, whether you have a good week or not a good week, right? It's not discretionary. It's not something you're going to decide at the end of every pay period. Hey, I just paid my credit card bill, my phone bill, my rent. Do I have the ability to save and invest now? Maybe not. I think I want an Xbox instead, or I want an iPhone 13. And you may defer to short-term wants instead of long-term needs. And so when you set things up automatically, they happen automatically. You've put it into autopilot. It's a great way to direct savings, and as we'll discuss, investing as well. Now, saving and investing are both laudable goals, but they're slightly different. Saving, we're usually going to put in a bank product, somewhere that it's really liquid. We can get to it easily. It's very safe. Like a bank is FDIC insured. If it's in a credit union, it's NCUA insured. You're not going to lose this money. However, you're also not going to make a whole lot of return on this type of money, right? I don't know what my bank account is paying me in interest, but I think it's something like 0.1% interest. It's minor, it's minimal, but I don't mind that because I need this emergency fund. I need this fund in my bank where I can pay my bills from. That's important. That's saving. Investing is a little different. Investing is that portion of our overall portfolio that we're actually willing to put at risk. And you might say, hey, that's counterintuitive. I don't put anything at risk. But you may put some money at risk because money that is invested has a better chance at earning a better return over time than money that's just in a savings account. That's why some of our longer term needs, like a comfortable retirement or maybe a home that we want to purchase someday, may be in investments. Now, here's another reason to consider not putting all of your money into a bank account or into a coffee can in the backyard. The cost of goods and services tend to go up over time. If all of your money was in the bank, you're not going to have the same buying power a year from now, 2 years from now, 10 years from now, right? Because inflation will eat away at your actual buying power. And so like this Ford Mustang 25 years ago was $24,000. If you want that car now, it's almost double that, right? And it's not just cars, it's the food that we eat, the rent that we pay, the tuition credits that we earn. Everything gets a little more expensive. And so if we want to have the same or better buying power in the future, we need to invest some portion of our portfolio. Now, how does money grow when we invest it? Well, it grows through what Einstein considered the eighth wonder of the world, and that is compounding, this phenomenon of compounding where money earns a return. And then not only that initial money invested earns a return the next year, but also the return that you earned that first year earns an additional return, which sounds so ridiculous that I just like to use the analogy of the snowball. You pack that snowball tight, you lay it on the ground, you turn it through one rotation, and what happens? You've picked up a little bit more snow. That increases your surface area so that by the second time you do a rotation, you have even more snow. The snowball is getting larger. Well, that's what can happen with investments. Your money can grow. Your money can work for you over time, but it takes you putting that snowball down and starting that rotation. How do investments grow? Well, that depends which type of investment we're talking about. Remember, this is just a quick refresher here. Stocks are where we actually own a sliver of a company. You could be a tiny partial owner of, for example, Amazon, right? And you can make money a couple different ways if you hold a share of Amazon stock. One, you could buy low and sell high. That's called capital appreciation. But two, if you bought the shares of a company that actually shares their profits with stockholders, you can get what are called dividends paid to you, and your snowball can get bigger in that respect. With bonds, don't think of it as owning a slice of ownership in a company, because with bonds, it's a little different. It's actually loaning money to a company or to the government. They will hold on to your money for some period of time. And while they hold on to that money, they'll pay you some interest. And when that bond period ends, they'll return your principal, the money that you originally invested. That's how your snowball grows with bonds. Then there are these things called funds, like mutual funds, like exchange traded funds. That's where a group of us investors pool our investments. Instead of only buying Amazon stock, we might buy dozens or hundreds of different companies' securities. And you make money when you hold a fund if those hundreds of companies grow in the aggregate, or if those hundreds of companies pay in stock, the dividends or capital gains or any other earnings such that you get additional shares of the fund. That's just a way that your snowball can grow with fund ownership. Now, How might this look? It might look like this. Let's say you start a new job. You commit to contributing $100 per month into an investment, say it's your 401k or some other investment, and you do this over your whole career. Let's say you have a 40-year career. The amount that you will have contributed at the end of that 40-year career is represented in the blue line on the bottom of the screen here, right? After 40 years, you've contributed $48,000. But because your money was invested and because it was subject to this great phenomenon of compounding, we're just assuming for purposes of this example of a 7% average return. Look at the red line. That's what you're actually earning. That's how your money begins to work for you. It's how your snowball rotates in the snow and gets larger and larger. At the end of 40 years, you have almost $240,000, even though, again, you only put in $48,000. Very important. The concept of compounding. That's your commitment plus time equals growth over time. Now, will investments be so linear, so predictable? Actually not. And it's really important to make this clear up front. This is the Dow Jones Industrial Average. These are large US stocks over the last 30 years. And you can see it's not that perfectly linear line that I just showed you. Instead, there's significant volatility with stock investments, right? There are ups and downs, especially in short periods of time. And for many of us, we lived through the housing crisis in 2008 and 2009. And remember, that was a time where many of us saw our 401ks or our other investments drop 30%, 35%. It was scary times. But I would want you to think about the trend in stocks over that time. Look at the trend here. What is it? It's up. And historically, stocks have done very well, even going all the way back 100 years to the stock market crash of 1929. Stocks have done quite well. They've paid somewhere between 7 and 9%, depending on how you factor that over those periods of time. And so while there is volatility, you need to understand you're going to have market corrections and dips. If you're in an investment for a long period of time, investors have historically done quite well with stock investments. And so what's the takeaway here? Because compounding requires your commitment and then time, the earlier you start investing, the less money that you actually need to invest to reach your goals. So let's say you want to have $500,000 by the time you hit the age of 65. If you start in your mid-20s, you only have to put about $200 a month into an investment. But if you wait till you're in your mid-50s, you have to put $3,000 a month into an investment to reach that same goal. That's an onerous amount. Nobody wants to do that. So the takeaway is always going to be, it's better to start investing today than to wait 5 years, 10 years, 15 years. Why? Because you won't have to put as much away to reach whatever your goal is. Automation is important. Even small amounts, like this amount is like buying a Starbucks venti coffee one day a week, or one day every business day of the week, right? Even these amounts add up when you automate it. When you just set it up with your HR department so that some piece of every paycheck goes to your emergency fund and goes to your 401k or whatever investment that you're doing. You could have almost $40,000 after 20 years by just skipping that venti coffee, right? It pays to start. Now, all investments have risk. We stated that earlier when we were talking about the difference between that bank account and an investment, right? With investments, there's risk, but we don't have to be afraid of investing because there are steps we can take to mitigate or manage or reduce the risk of investing. I want to talk about two of them today. That is asset allocation, choosing what to invest in the first place, and diversification, spreading our investing eggs among multiple investing baskets. Now, to know asset allocation, you have to know this important relationship. In investing, typically, the potential for higher return comes with higher risk, okay? That's why this yellow line here represents that risk and return line. In the bottom left, we see those really safe bank type products, okay? Bank accounts, those certificates of deposit, money markets. They're very safe. We're not going to lose money, but we're also going to have very modest returns with those types of investments. As you move up the risk and return line, you've got a little more upside with bonds, for example, in the middle, but also a slightly more risk. Bonds have been about moderate risk, about moderate return historically. In the upper right, that's where you see those high upside but high potential risk products like stocks and funds. Okay, stocks and stock funds again have paid between 7 and 9% historically over time. But any particular stock might present considerable risk depending on any number of factors, right? Is the company well run by the management? Is the product doing well vis-a-vis its competitors? Are there tax policies or regulations that are impacting the company? Are there labor strikes or pandemics that impact the workforce? All of these things could drive down the share price of a particular company, but all in all, stocks are generally high upside. Now, knowing that, these risk and return relationships can help you decide what to invest in the first place. Two important factors when you're deciding what to invest in: your time horizon, that's how long until you need the money, and your risk tolerance, that's how much risk do you want to take on. Now, in investing, typically, the longer your time horizon, the more risk you can potentially take on. Why? Because you don't need your money right away. And if there is a market correction, you have a long time to make up for it or to recover from it. So typically, that's going to be the situation. How might that look? Let's talk about another factor: diversification. So we've chosen the types of things we're going to invest in the first place. Now let's just take one asset class, say stocks. Instead of only investing in, say, a handful of tech stocks, diversification would say you should probably have exposure to consumer goods, financial sector, industrial sector, right? So that if those tech stocks have a bad week, your other investments in other parts of the market may help you avoid a loss. Here's another way of looking at it at diversification. Let's say you have your entire net worth on Microsoft stock in the upper left corner here. If Microsoft goes down, and it's colored red on this chart, it went down on this particular day, you've had a bad day. But if instead of having your whole net worth on Microsoft stock, let's say you had a S&P 500 index fund, right? This chart shows all 500 of the Standard & Poor's US companies that make up the S&P 500, right? If you had an S&P 500 index fund here, just looking at the reds and the greens, it looks like you may have even broken even or may even be up. And so the theory of diversification says there's safety in numbers. If one particular company, like in this example, Microsoft, or one particular sector, like in this example, the tech sector in the upper left, has an off day, your exposure to other parts of the market may insulate you from losses or maybe even help you have gains. Okay, that's the theory of diversification. And it's a big reason why a lot of people recommend investments in products like mutual funds and exchange traded funds. Why? Because they give you that diversification. They typically have dozens, if not hundreds, if not thousands of different securities in them, and such that if there's one particular sector that's having a bad day, you won't have to see an overall impact to your portfolio. With asset allocation, a lot of people like products called target date funds, or if you're with the government, they call them life cycle funds, right? This is where you pick some sort of target date off in the future. Oftentimes it's when you want to retire, when you want to start using your accumulated wealth. And in target date funds, they'll automatically make adjustments to your asset allocation as you move throughout your career. Typically, they're going to be really aggressive when you're in your 20s and 30s, when really what you want to focus on is growth and returns. But then as you move into your 40s and 50s, they will automatically adjust your asset allocation mix to a more conservative allocation as you approach retirement. Why? Because as you get really close to retirement, you don't want to take those big risks. Returns may not be as important to you. Safety may be more important to you. So that's why target date funds tend to be really aggressive early, and then they slowly but automatically shift to a more conservative mix of bonds and cash and those sorts of things as you approach retirement. People like this because they don't have to change their asset allocation every year or 5 years. It does it for them. It's one of these autopilot type investments. Now, are there things you can invest in besides stocks, bonds, mutual funds? There are. And if you're new to investing, be very careful. Watch where you're getting your information, okay? Just because Matt Damon tells us something is a good investment doesn't mean we're going to make money on it. Because Matt Damon was paid handsomely doesn't mean we will be paid. So be very careful. Celebrity endorsements really are an indication that the celebrity has been paid, not that this is the right investment for you. Here's another shocker. There is bad information on social media about investing, in chat rooms, on memes, on Twitter, in Facebook, in Reddit rooms, whatever. Be very careful if you're looking for your guidance from social media or from your family member who claims to be making a killing on something, or a coworker who's showing you their phone and showing you all their trades that are making big bucks. Be careful, because all of these sources, even if the information is arguably sound, if those folks don't have the same time horizon as you or the same risk tolerance as you, it may not be an investment that's right for you. So be very circumspect. Do your own research, kick the tires, do your due diligence. Always great to seek out unbiased, product neutral sources like investor.gov or like your local public library, right? If you hold a Fairfax County public library card, you'll have access to various resources like Morningstar, like Value Line, where you yourself can do research on investments from sources that perhaps you can trust. And remember, play the long game with investing. I don't know anyone who's gotten rich quickly with investments or with anything else for that matter. Maybe a lottery winner here and there or that sort of thing. But for most of us, this is a long game. You have to start early, be consistent, be diligent. That's how you make money. Now, can you invest outside of stocks, outside of bonds, outside of mutual funds? Well, of course you can. There are these alternative investments out there, but remember, typically with alternative investments, there's going to be less government oversight, less government regulation, and therefore to you, more risk. So be careful. We've got information on these and many other investments on investor.gov. We get a lot of questions on crypto, so I thought we'd have a couple slides where we talk about this. What do I mean by crypto? Well, I'm talking about things like digital tokens. I'm talking about non-fungible tokens. I'm talking about cryptocurrencies, things that claim to be an alternative to fiat currency. What's the big deal about these? Well, the proponents of these types of investments will say, hey, the best thing about them is that they're decentralized. They're not really affiliated with any bank. They're not really regulated by any government. Do they exist in physical form? No, they exist in digital form, okay? They are recorded on the distributed ledger called the blockchain. Servers around the world record these transactions to know who's paid for what, who is holding what, using a very complex coding system. They're supposed to be difficult to counterfeit or to duplicate. So this is what I'm talking about with crypto assets. What are the risks of holding these assets? Well, first risk is that these are relatively novel investments. Even the grandfather of cryptocurrencies, which is Bitcoin, has only been around for about a dozen years. So there's a very limited track record out there. These investments also are speculative. What do I mean by that? I mean that you could lose a lot of money. You're buying these things with the hope that someone will pay you more later. Very different than investments that have intrinsic value. For example, a share of that Amazon stock we talked about earlier. When you hold a share of that Amazon stock, you actually own a piece of Amazon's profits. You have a piece of Amazon software that matches buyers to products. You have a piece of ownership in their trucks, their warehouses, their employees, right? That's different than something where you're only buying something called a cryptocurrency, and the only way you can make money is if you pay here and someone else pays more. If someone pays less, you're losing money. Is the regulatory posture light? It is currently, but that could change. In fact, many would argue the winds of change have already started blowing, right? Not only from the Securities and Exchange Commission and other federal regulators, but also from regulators around the world. Different countries may enact or create a stricter regulatory regime around this. So if that's why you're investing in this, be aware that could change. And you're not going to get the same protections, investor protections, when you hold a cryptocurrency as you will, or a crypto asset as you do when you have a stock, a bond, your 401k, that sort of thing. What are some other factors? Well, crypto is highly volatile. What do I mean by volatility? I mean the price can change 20% in a week on some of these things, maybe even less. This screenshot is showing you sort of the roller coaster ride that Bitcoin went on over the last 2 years. You can see these two huge hills, but you also see two huge troughs. Okay, and if you're buying up there along those peaks, you could lose a lot of money. Volatility is not necessarily your friend. Some of that volatility can be due to market manipulation. This is where bad information is out there that changes the price of the currency or the crypto. Not a whole lot of transparency, not a lot of accountability or governance issues when you're dealing with these crypto assets. There are many bad actors in this space. Okay, we see a lot of illicit transactions, like drug lords who are laundering money, like terrorists who are moving money internationally, even Russian oligarchs who, when they had their yachts frozen or their Manhattan townhouses frozen, moved a lot of their wealth into crypto. Why? Because it's anonymous. It's difficult to track. There have been hacks and cybersecurity problems with some of these coins and currencies. If you're thinking that you're going to buy pizza or buy a car or buy groceries with crypto, typically it's not accepted as coins or payments. So what these are speculative investments, very rarely being used for actual currency. And it's not exactly a green technology. I mean, mining just Bitcoin alone takes the energy consumption of a country the size of Sweden every year. So it takes a lot of money to run those servers, to create new coins, or to record these transactions. Takeaway: if you're considering investments that are novel, that are speculative, that are volatile, you can lose some or all of your money. So give very careful consideration to how much, if any, of your overall portfolio you want to devote to these types of alternative investments that present additional risk. Give very careful consideration to that. Have we seen scams in the space? We certainly have. This is just one example. The SEC brought in action against BitConnect. We alleged that they were inducing folks to lend their Bitcoin, billions of dollars worth, to the BitConnect. They were promising profits that were going to be generated by bots. But what they were doing was they were paying the promoters to give testimonials and to create videos on YouTube that made this look like such a great product. The promoters were saying how much money they made. They were being paid to say that. It rewarded those same folks, those investors, to recruit new victims. So it had a little bit of a pyramid scheme aspect to it. They were promising big returns with very little risk. As we'll say in a few minutes, that's a big red flag. And they were paying older investors who they had promised these returns to with money that was just coming in from newer investors. So it also had a Ponzi scheme element where they were taking money from new investors and giving it to the folks who had been involved earlier. So some of those early adopters were getting money and the new folks were left holding the bag. This is sometimes the case with a lot of these crypto schemes. So what are the markers of a digital investment scam? Hey, they're promising you high guaranteed returns, okay? In investing, the potential for higher return typically comes with higher risk. So there's no such thing as guaranteed returns. They're almost always unlicensed, unregistered folks. They're not broker dealers. They're not investment advisors. You can check this on investor.gov. We'll talk about how in a few minutes. They're on YouTube saying, hey, look at my skyrocketing account values. I'm getting rich from this. Watch out when you see that. That's easy to fake. Any investment that sounds too good to be true probably is. And remember, some of those testimonials and all of those celebrity endorsements are being paid. Very easy to fake whether or not they actually believe in the product. Why? Because they're being paid. They're reading a script. Watch out. Now, many of you are using investing apps. Many legitimate investing apps out there. I'm not here to tell you they're scams, but I am going to tell you, take a few steps. First, if you're using an investing app, make sure they're licensed and registered to do what they say they're doing on investor.gov. For example, Robinhood is a licensed broker dealer. It can help you buy and sell securities. Betterment and Acorns, there are two examples of licensed investment advisors that those apps can give you investing advice. If you're using a different app, just check it out. You can do this as quickly as you're checking a Yelp review for the nearest restaurant. You can make sure they're licensed and registered. Second point, they always advertise no fees or low fees, but many of these apps are being compensated. So make sure you read the fine print, make sure you're comfortable with how they're being compensated. If you like to talk to a human being when you have a question, be careful. Most of the apps aren't going to give you that opportunity. Instead, you're going to have to go through an online portal or send an email. That can take some time. Just know that. Some of these apps disturbingly give very unsophisticated new investors access to complex or high risk products or strategies. Things like margin trading, where you're borrowing money to make trades, or options trading, where you're buying calls and puts, and you're buying the opportunity to get a stock later at a certain price. These are very complex strategies. You could lose more money than you actually invest with those types of strategies. Be careful. If you're engaged in that type of trading, get on investor.gov, educate yourself, and be careful. The apps make more money if you trade more. As a result, they've gamified this process to make it more likely that you will trade more, right? You're going to see those video fireworks when you buy a new stock. You're going to see the confetti when the stock price goes up. You're going to see the app sharing great portfolios of stocks that are making big bucks for our other customers, right? Why? All of this is to deploy a nudge to make you more likely to trade today. They want you to trade more. Don't let your online investment app become a gambling app, right? You trade at your strategy or at your comfort level, and don't be nudged into doing more. Why? Because trading more does not necessarily benefit you. Studies have shown folks who trade more tend to underperform the market. Day traders tend to show poor timing. They're following the crowd. They're overreacting to good news and bad news. So be careful. Also, if you're moving into the market and out of the market, you're one of these market timers who's in cash, and then you're back in the market, then you're in cash. Be careful with that strategy too, because another study has shown that even missing a handful of those surge days where the market's really pumping can impact your overall returns over a long period of time. And so I go back to this long-term strategy might be your best bet, right? A consistent buy and hold strategy of low fee, diversified investments that you stick to throughout a career may be better than trying to be a day trader and picking a handful of stocks. You're not very diversified, and you may underperform the market. And this is critical to remember. When you buy and sell securities over a short period of time of less than a year, or you're buying and selling crypto, even if you make profits, and many people don't, but even if you do, you're going to have to pay a much higher tax rate on those types of profits. Usually it's your ordinary income tax rate. Why? Because You don't get the benefit of those long-term investments where Congress has incentivized you to make those long-term investments like your 401k. So you're going to pay higher taxes on those short-term gains, those those um, those buys and sells that you're doing within a year. Okay, why don't we talk a little bit about planning for retirement? Because here's an example of a tax advantaged investment, right? Your 401k. If your employer offers a employee retirement account like a 401k, a 403b, 457, take advantage of it. The IRS will let you put a significant amount of money into this account, $20,500 this year, an additional $6,500 if you happen to be over the age of 50. That money can then grow throughout your career, and then you can start taking those withdrawals in retirement and living off those proceeds. We'll talk a little bit about how it's taxed. You can also have an individual retirement account, one that you set up yourself, doesn't have to go through your employer. You can put $6,000 a year into an IRA, an additional $1,000 if you're over the age of 50. These are tax advantaged accounts. What kind of tax advantage do you get? Well, that depends on whether you contribute traditionally or via Roth. Okay. With those traditional contributions, you're going to get a tax break now, this year. You'll lower your taxable income. That money will then grow throughout your career. And when you take those withdrawals in retirement, that's when you're going to pay your taxes. You pay later. Tax break now, pay later. With Roth contributions, it's the exact opposite. This is where you're actually opting to pay the taxes now. Let that money grow throughout your career. And then later in life, when you're taking those withdrawals, you benefit from tax-free withdrawals. Why might you choose Roth? A lot of people choose Roth at the earliest part of their career when their earnings are relatively low. And typically when our earnings are relatively low, what else is low? Our tax burden, right? So you're basically making the calculation. I might as well go ahead and pay the taxes now while my earnings are low and my tax burden's light, and let me reward myself in my 70s, 80s, 90s with tax-free withdrawals. That's the benefit of Roth. And you can do one or the other, and it's up to you which makes the most sense. You can actually do both. You could split your contributions to either one. So what are the takeaways? Don't delay. Time is your friend. Start investing as soon as you start that new job. If your employer has a match, take advantage of it. How do you do that? Let's say your employer says, hey, I'll match your contributions to your 401k up to 5%. Well, what do you want to contribute? You want to contribute at least 5%. Why? Because that way you get your 5, your employer's 5, and it's like building a house where every time you put your hand down, 2 bricks show up instead of 1. You build wealth that much quicker. Contribute consistently and pay attention to fees. I'm not going to dwell on this on today's conversation, but fees can add up. They can really gobble up your return. So when you're choosing a 401k investment, research how much it will cost you to own that particular fund. There's a great tool for that, by the way. Our friends at FINRA, the Financial Industry Regulatory Authority, have a tool called Fund Analyzer. And check that out. Fund Analyzer will let you get an apples to apples comparison of the overall expense ratio. That's all those fees together of almost 35,000 different funds and ETFs. So this is important. Now, there are hundreds of thousands of people who have become millionaires through their 401k. And here's how they've done it. They start early, probably from day one, participating in their 401k. If the employer offered a match, they took advantage of it all the way up to the top of the match, whatever that is, if not way more. They contribute aggressively. A lot of these folks go all the way up to the IRS limit every year, right? If they can afford to do that. They contribute consistently. They don't stop contributing if the market drops. In fact, they look at market drops as a way to get stocks on sale. That's where you acquire a bunch of shares of a different fund. And then when the market recovers, you're poised for making more wealth. That's a great time to just keep going. Don't change your strategy just because the market fluctuates. They contribute throughout their whole career. Oftentimes, this is 30 plus years of contributions. And they pick an investment strategy that makes sense for their time horizon, right? They're either in a lot of stocks or they've chosen one of those target date funds that picks the date way out in the future when they ultimately want to retire. Great advice. And that's how you can get rich, right? Like the turtle here. It's not get rich quick, it's get rich slow and steady. That's how most folks do it. Remember, I heard a statistic that millennials will change jobs an average of 12 times throughout their career. If you contribute to a 401k and move to a new job, you can keep some or all of it in that former employer's plan, usually. You could transfer it. It's a tax-free rollover to go to your new employer's 401k. You can do that, or even to your own individual retirement account. You always have that option. Can you take retirement money out and spend it on non-retirement purposes? Well, you can, but watch out, because remember, if you're under the age of 59 and a half, you're not only going to have to pay whatever taxes you owe on it, but you'll also have to pay an additional 10% penalty by the IRS. And for folks who do that, they sometimes get only 50 cents on the dollar. So not a good policy to try to take retirement money out for non-retirement purposes. All right, real quick through fraud, and let's get to questions. If something sounds too good to be true, presume that it is. If someone pressures you to buy right now, walk away. No legitimate investment requires you to make a rash decision. And if somebody's not licensed and registered to buy or sell securities or to give you investment advice, don't use them, okay? How do you know if they are or aren't? You get on investor.gov, you type in their name or the name of their firm right there on the landing page. Find out if they're licensed and registered. Take a look at their employment history. Make sure there's no red flags, things like customer complaints, disciplinary actions. Make sure you're comfortable with their record. If you're going to invest, do your research, okay? Let's not just trust someone who's selling us an investment. You can look up, for example, 7,000 publicly traded companies. You can look up on a tool called Edgar. Edgar lets you see who are the officers and directors, what do the audited financials look like, what's management saying are the risks, what are their quarterly and annual filings. All these things you can find on Edgar, and that's just one source. Again, the library has sources. The internet has many legitimate sources. If you get a demand for money for claiming to be from the government, watch out. There have been a lot of scams in the space recently, right? If it's the IRS, go to the IRS website, call that 800 number and say, hey, I have a demand for back taxes of X amount. Is this legit? Don't pick up if you don't know who's calling. If you do pick up, don't share private information. Be careful if you're being told to pay for an investment with specific types of payment plans, like those untraceable, irreversible payment methods, like pay me in cryptocurrency, or give me Target gift cards, or wire some money overseas. You do any of those three things, you're never going to see that money again, right? It's gone. If you're using a payment app like Venmo or Zelle, make sure you know the person or trust the person that you're paying, okay? Just because once you've paid, it's gone. And remember, if you're paying for legitimate investments, things like buying stocks, bonds, mutual funds, and someone's telling you to pay with a credit card, that could be bogus. Most brokers will not allow you to pay with a credit card. All right. A reminder that we have great resources. Here's investor.gov. Got a lot of great stuff on there. Please poke around today and see if there's something that interests you. The most popular page happens to be our compound interest calculator, which you see right here, one of our tools that we have there. We've got thousands of investor alerts and bulletins. This is just a handful of some of the recent ones that may interest you. They're all term searchable. If there's a topic you're looking for, type it in the upper right and you'll go straight to it. And if you need help with your investments, you need help, you have a question about your investment professional, reach out to the SEC. We have an 800 number, 800-732-0330, but we also have an email address, help@sec.gov. You can send your questions in. Our team of investor assistance specialists can help you. We're also on Twitter and Facebook. We would love it if you followed us and liked us. And with that, I'm going to open it up for questions. And I'll also ask if you have 2 minutes when we're done today, please take a quick 2-minute survey. I will put this in the chat box, what the survey is, so you can just click on it. We would love to hear from you because we're always trying to make our surveys better. And this is one way we can do that, to know whether we're touching on topics that interest you and that hold value for you. And so I will stop my share.